The New Jersey Bank Marketing Association presents Forecast 2010, a series of conversations with New Jersey's bank leaders about their outlook for the coming year. I'm your host, Steve Lubetkin. In this segment, Tom Geisel, President and CEO of Sun National Bank, with his outlook for the year 2010. Now let's go to the lectern where Jane Gore will introduce Tom Geisel.
Our next speaker is Tom Geisel from Sun Bancorp and Sun National Bank. Mr. Geisel joined Sun in January of 2008, bringing more than 20 years in financial service experience to his position. His well-diversified background includes experience in investment banking, private equity investing, and commercial banking and executive management. You've seen him on various business news networks, including Bloomberg News, CNBC's Squawk Box, the Fox Business Channel's Cavuto, and America's Nightly Scoreboard. He's also contributed articles that have appeared in national publications, including The American Banker, U.S. Banker, and the Wall Street Journal. Prior to joining Sun, Mr. Geisel held a number of positions with KeyCorp. He was president of KeyBank's Northeast region from 2005 through 2007. He's also represented the U.S. Department of Justice in various capacities domestically and served as a diplomat in Latin America and the Caribbean. He attended college in Tennessee, and I don't think it was for golf. I think he said something about football. And he's a longtime resident of Cherry Hill. Please welcome Mr. Geisel.
Thank you. Jane, thank you very much. If nothing else, I have impeccable timing. I came back to New Jersey and joined Sun in January of 2008. Perfect, huh? With a pedigree of working for the government, being an ex-investment banker, and now a CEO of a bank. Another triple threat, right? I'm everybody's fan in the marketplace. But thank you very much, and appreciate all of you being here today. It's certainly nice to be in a room full of individuals who understand the financial services industry. I applaud you all for your guts and your consistency and sticking with it through these tough times. It's certainly not something for the faint of heart, but we love this business. We're in this business today. This too shall pass, and we'll be in this business tomorrow and 2 years from now. That said, the current chaos or the past chaos of the last 2 years, I'm a firm believer, creates opportunity as we move forward into 2010. I think 2010 is also going to be a very interesting year, but it's going to be interesting for some different reasons. With that, today what I'd like to talk about is kind of the banking industry as a whole, talk about the banking industry in New Jersey, what are some of the challenges we're going to face in 2010, and then what are some of the possible opportunities that we're going to have to overcome those challenges. But before we can talk about all of that, I think we need to take a little bit of a quick trip down memory lane and understand kind of where we came from, where we are now, and that'll be a good basis for kind of where we're going in the future. I apologize, I don't have any overhead, so you're going to have to look at me for the next 15 minutes. But in 2008, going back to 2008, we saw a 400 basis point drop in both the LIBOR and the Fed funds rates. And that was pretty dramatic in a 12-month period of time. And that rate environment has held flat through 2009. Every Monday was worse than the prior Friday. We had a series of events that one of those events alone in a year would have been catastrophic. And we had literally dozens of them happening at the same time. It was certainly a scary time that put the industry and the economy in a very tenuous position. And no doubt we're in more stable times, and I think we're all happy to be here right now. You know, we can look around, and hindsight's 2020, and we can blame a lot of different people and a lot of different organizations. But if you really look around and you're honest and you look in the mirror, you know, consumers were overspending. Investors were buying properties with the hopes of arbitraging a quick profit. Home buyers were getting greedy. They were purchasing houses and other items that they knew they couldn't afford, and in a lot of cases using those homes as piggy banks. Mortgage companies, especially those non-regulated mortgage companies, were all about sell, sell, sell. Very low doc or no doc mortgages. And the banks have some of this certainly to blame also, have to share a piece of this. A lot of banks were using highly sophisticated, highly complex, exotic financial instruments that eventually backfired on them. And when larger, too big to fail institutions started having trouble, it was definitely a domino effect that affected not only the financial services industry, but the economy as a whole. The blame game turned into a game of hot potato, and no one wanted to be left holding. But when that happens, everybody's left holding the potato, and we all start to feel the heat. As time went on, we got TARP. We got increased FDIC assessments, higher capital requirements, and a tougher regulatory environment. And some of this was absolutely appropriate based on the history. But as we move forward, I believe the sector that's going to feel the most pain in financial services are the small regional banks and the community banks, because those are the banks that are having to contribute more proportionately to the safety and soundness of this industry as we move forward. And those are the groups that have the less financial or diversified resources to be able to afford to do so. Isn't it ironic that, to a large degree, the mega financial institutions with their complex balance sheets and trillions of dollars in assets contributed significantly to the situation? And now it's the local and regional banks that are going to have to contribute significantly to fix it. I think it's equally ironic that the government is willing to let regional and community banks pay the ultimate price of failure when the others are deemed too big to fail. I'd like the government to give us the moniker of too vital to the community and give us some of maybe those resources and thoughts that the too big to fail institutions are getting. It's no doubt that the competitive banking landscape across the country dramatically changed in 2009. More than 120 U.S. banks failed, the highest failure rate since the savings and loan crisis of 1992. And you hear a lot of other statistics out there, but many people agree that that number, before it's all said and done, is going to be at least 3 to 4 times that 120. In addition to bank failures, the current marketplace drove and it is driving consolidation, especially among the largest banks. I mean, you know many of them. J.P. Morgan bought Bear Stearns, Bank of America, Countrywide, and Merrill Lynch. Wells Fargo purchased Wachovia, and closer and nearer dear to our heart, PNC and National City. But the same consolidations have also swept the smaller regional and the community banks. Hasn't happened so much in this market. It was mostly in those markets that had real issues with the residential and commercial real estate market. But with all this movement, there's no doubt that the faces and names are changing in the banking industry. And this market, I believe, is going to be much different in 2010 than it actually is this year. The concerns over loan loss provisions, decreasing asset quality, real estate values has created a very volatile public market for all banks. The market fluctuates with even the slightest bit of good news, and it also fluctuates with even the slightest bit of bad news. And that movement is really agnostic to whether you're a too big to fail bank, you're a regional bank, or you're a publicly traded community bank. If you take a look at the recent earnings of some of the too big to fail banks in the third quarter, many of them had some decent earnings. So in other words, they were profitable in those quarters. But if you really go and dig into the earnings releases, you'll find that a lot of those earnings came from non-banking or non-core banking businesses, whether they be trading businesses or merger and acquisition or more investment banking type of businesses out in the marketplace. Very little of it came from the good, core, stable banking operations that many of us live and breathe with every day. And many of those banks have yet to pay back TARP. We just heard an announcement about Bank of America. Let's see, how that pans out over the next several months. If you look at the regional and community banks, those earnings are flat to down based on the effects of the continuing softening really in the residential and the commercial real estate market. But flat is not really too terrible of a place to be right now based on everything else that's going on in the marketplace. Since I mentioned commercial real estate, I think it's worth taking a moment to discuss that as well. Everyone continues to be mindful of the depressed pricing in commercial real estate, and that banks in general will still feel some pain as a result of their concentration in that portfolio. All told, U.S. banks may face defaults on up to 10% of their $1.1 trillion worth of commercial property loans. Among the 36 regional banks, and those are the banks with less than $20 billion in assets, evaluated by Fitch Ratings, commercial property exceeded 25% of total loans, compared with 10% or less at the nation's 4 biggest lenders. Federal Reserve Chairman Ben Bernanke has gone on record to say that souring commercial real estate loans may slow improvement in banks' balance sheet and hold back economic growth. The highest unemployment rate since 1983 has also exhausted a demand for office and retail space, pushing down prices 40% since October of 2007. And that's according to the Moody's REAL commercial property pricing indices. So bank failures, consolidations, the current volatile market, depressed earnings, and rising concerns about the commercial real estate pretty much paint the state of the banking industry. Everybody's smiling now, everybody's excited based on that great glowing review I gave you of the industry. It's going to get better. I firmly believe it's going to get better. But before we talk about how it's going to get better, let's take a look at New Jersey for a moment. As we move into New Jersey, obviously we're seeing a lot of the same trends that are happening across the country. But I found some interesting research that was published by the Federal Reserve Bank of Philadelphia that I want to share with you all. These figures are from their second quarter 2009 report, and it comes from the tri-state area that they define as Pennsylvania, New Jersey, and Delaware. So New York is not included in this. But what I found interesting is that while banking as a whole is down, community and regional banks in our region through the second quarter of 2009 are down less than the national average for the same size banks, an indication that we are holding up relatively well amongst the others. Here are some additional facts and figures to think about. Non-performing loans to total loans. National average for community and regional banks is about 3.6%. Tri-state area's average is about 2.4%. And this figure nationally is lower at the community banks and large institutions. Quarterly net charge-offs to average loans. National average about 35 basis points. Tri-state area about 22 basis points. Non-performing commercial real estate loans to total commercial real estate loans. National average about 5.5%. Tri-state area about 3.5%. Net charge-offs to loan loss provisions. National average about 75%. Tri-state area about 62%. Additionally, local regional community banks' asset quality, while still not great, is certainly better than larger banks. Our regional and community banks are also doing better than larger banks in residential real estate. The ratio of non-performing residential real estate loans to total residential real estate loans at national banks is 2.22%. The tri-state area regional and community banks is 1.37%. And for many banks, mortgage lending has been outstanding this year, but a lot of that has to do with the rate environment and not so much the new purchases, but certainly the refis. Finally, deposits at local, regional, and community banks increased at an annualized rate of 9.6%, where they were basically flat nationally. So again, while the tri-state area regional and community banking figures aren't exactly where we want them to be, it's interesting to see that we're performing slightly better than certainly the larger banks and our national peers. And I think that's something that's going to put us ahead of the curve as we start to get into 2010. But as you look through the numbers and the stats, and you look at the state of banking in our region versus the larger banks, granted it's not great, but again, even being flat or a little down or ahead of our peers is better than where we could be. There's a big wild card out there. And Ray talked a little bit about that wild card, and that wild card is the regulatory environment. What's going to happen next? If the regulatory environment continues to constrict the smaller banks, I firmly believe that we're going to have a redefinition of the community bank marketplace. Community banks aren't like the big banks. Big banks have a multitude of business lines and can diversify among products, services, investments, geography, and complex instruments. As you know, in general, the community banks were tied to a leaner core set of products and we don't have that diversified revenue sources that those larger banks have. And with the economy not rebounding as fast as everybody hoped it would, and smaller institutions not having access to as many capital sources or the resources like our too big to fail counterparts, I worry that overcompensating regulatory edicts on how we run our business could drastically hurt the community bank industry, as well as forcefully constrict the number of community banks in the marketplace. So what will we face in 2010? I've gone on record numerous times saying that one of the things that we have to be careful of as we go into 2010 is not to be too pessimistic or not too optimistic. We have to be grounded and we have to be just realistic. And all the facts and figures that I gave you about national and regional banks weren't to paint this doom and gloom picture of what's happening outside of our region, and it wasn't to paint a great picture of how well we're doing compared to our peers. It was really just to give you some highlights and put a grounding in on the realism of where the banking industry is right now and where New Jersey banks and this tri-state area that I defined holds up to that broader group. So what's to come in 2010? Here's a few thoughts. I think we will definitely continue to see consolidations. I believe that the regional banks are going to be the winners in a lot of this consolidation. I believe that the consolidations will absolutely come out of necessity. That necessity being forced two ways. One, because of regulations and oversight is going to force some consolidation in the marketplace. I also think that some banks are just not going to be able to compete from an expense perspective. It's going to be too costly for them to go out and raise capital, and/or it's going to be too costly for them to run their business. And from a shareholder perspective, they may be better off consolidating with other banks. But those are both necessities. Those are not warranted consolidations. Too big to fail, I believe, is going to turn into really too regulated to operate. We've all seen what's going on at GM, and I think that that's going to continue to happen in the banking industry. We've all seen, what's going on at Bank of America and the difficulty in putting a new CEO in place and all of the tugs and pulls around who's going to run the company. Well, I think one of the reasons why we're seeing that is because of the stricter regulations on compensation and certainly government involvement in the boardroom. We've got some absolutely stellar members of the boards of directors of these big banks, but just like politicians do, these individuals are looking over their shoulder to see what are the decisions they're making and what is big brother government and everybody going to say about those decisions. So I think those larger institutions are going to continue to be slower moving, and they're going to be not as decisive or demanding as they have in the past. This, however, to me is good news, because this creates opportunity, I firmly believe, for regional and community banks. But those regional and community banks have to be well capitalized, they have to be focused, and most importantly, they can't be afraid to make decisions to grab market share and also go out and be proactive on the acquisition front. To make this happen, however, we cannot have a bunker mentality. There's a lot of times when things get tough, people talk about, the tough get going. Well, if you think about it for a minute, you think about great athletes, okay? If a great athlete's training and it's raining outside, what does that great athlete do? They go out and they run in the rain. Why? Because they want to be better than anybody else, and they know they need to do it to win. So we can't be that athlete that stays in the house because it's raining. We have to go out, we have to get wet, we have to continue to hone our game. Now more than ever, community banks have to be able to define a plan and focus on the execution of it, and in doing so, they have to remain connected with their customers and their communities. That's the community bank and the small regional banks' competitive advantage. It's what has got us here. It's what's going to get us through, these next tough, whether it's 12 months or 18 months or 24 months. It's that connection with our customers, and it's that connection with our communities. We have to be engaged. If we don't work to control our own destiny, and you heard Ray somebody else will. So it's about us going out and being advocates for our industry. It's about being proactive. It's about controlling what we can control. And I think that we'll be able to stem what could be a drastic change in the landscape of the community bank marketplace.
You know, at the risk of being hogging the floor, I guess, but as I said, we work for a lot of banks throughout New Jersey and Pennsylvania, and it's really hard to judge where things are going from our perspective as well as an associate member. And the thing that one of the things you said that really caught me is this whole idea of consolidations going forward by regionals and smalls, community banks. Just talking about New Jersey for the moment, do you see that, or do you think that will be more the regional banks that are active in this regional, in this our region, acquiring the community banks, or community banks, generally speaking, every situation is different, obviously, merging and trying to get large enough to be, quote, viable in this changing environment?
Any of those of you who know me know that when I get asked a question, I have to be candid, so I'm going to be very candid with you. Take a look at Sun. We're the second largest commercial bank in New Jersey. Valley's number one. And there are other bigger banks than us. They're just not commercial banks. I don't see the PNCs of the world and the banks on that level at this point doing consolidations in the community bank marketplace. They're dealing with other issues. When PNC's case, dealing with the integration of National City. I think you're going to see smaller regional banks that are either headquartered in New Jersey or headquartered in New York or headquartered in Connecticut or headquartered in Pennsylvania that are looking to try to get more market share in very specific locations across the state. I think you'll see targeted conversations and targeted consolidations. So I don't think you're going to see a massive wave of roll-ups of community banks. That makes no sense at all. I think you'll see that there will be some banks out there that will come together and say, we've got a great connection with our customers and a great connection with our community. We're at a point, however, with the regulatory environment that we can't continue to function as we had in the past. It's going to make sense for us to partner with somebody who may have a little bit more diversification in product set, a little bit more of a diversification in revenue streams, and allow us to continue to service those communities and those customers. So that's what I see happening around the state. I see it being, more of a very, very targeted, methodical approach with the current bankers in the state, working together to try to make this state as strong as possible and not let the regulatory environment hurt how the New Jersey bankers have serviced their customers and their communities in the past. Make sure we can continue to perpetuate the good work that we've done over the years. Easy group, right? I think they're saving it all for Paul. That's good. Thank you all very much.
We hope you enjoyed this presentation from the New Jersey Bank Marketing Association. For more information, visit njbankmarketing.com. We produce these programs in the studios of Professional Podcasts in Cherry Hill, New Jersey. On the web at professionalpodcasts.com. This is Steve Lubetkin. Thank you for joining us, and we'll see you out there on the net. Take good care.